So we're very proud, very, very proud active managers through great research across credits, rates, different sectors that we are able to beat benchmarks. If you want to be an investor, make sure you're very curious, make sure you're constantly learning, make sure you're learning the skills of the future.
In a story of grit and persistence, Jean Hynes began her career at Wellington Management not as an analyst or portfolio manager, but as an administrative assistant.
I started at the very lowest part of Wellington, but a recruiter had told me, don't worry about the title. This is a great firm. The culture is amazing. You're going to have lots of opportunity.
3 decades later, she now leads the $1.3 trillion investment firm as CEO. As the daughter of Irish immigrants, Hynes was the first in her family to go to college. She graduated from Wellesley with a degree in economics and found her way into investing during a difficult job market in the early 1990s.
My father was a bricklayer, and my mother raised 6 children. So really, I was a first-generation college student.
Her breakthrough came in 1993 when she began working with Ed Owens, a legendary healthcare investor and her mentor for 20 years.
It was just a match made in heaven. Most of my career was focused on analyzing and recommending and investing in biotech and pharmaceutical companies.
From there, her trajectory accelerated. She became a partner within 9 years, later led the healthcare team, and in 2014 was elected managing partner. By 2021, she had risen to the top job.
When I think about that period of time, that was my real journey on being a leader.
Today, she leads a global team of 3,000 people, emphasizing Wellington's collaborative culture, focus on long-term performance, and expansion into hedge funds and private markets.
I think the hard thing to do is to beat benchmarks over time. That is a very rare high skill.
Hynes says the best investors share a common mindset, driven by curiosity, grounded in humility, and strengthened by resilience.
We're not a star culture. The two combinations of being great investors are being super curious, being humble, and being resilient.
So for those who aren't that familiar with the financial world, what is Wellington Management?
So Wellington Management is an investment management firm. So we manage money for a fee for our clients, and we specialize in equities and fixed income, hedge funds, and privates.
So you started out for public equities and then maybe fixed income, and privates are now more recent?
So when I joined Wellington in 1991, it was very much focused on equities, and I would say even value equities. If you think about my 3 decades at Wellington, it was really expanding in equities that first decade, expanding in fixed income in the decade of the 2000s. And in the past decade, we've really expanded into, we've been in hedge funds for 30 years, but expanded our hedge fund footprint as well as our beginning our footprint into privates. We now have 7 teams that focus on private investing.
How did Wellington pivot from being an equity-focused firm to being a fixed income and then now investing in privates? When did that happen?
So we started in the hedge fund business in 1994. So we've been in the hedge fund business for over 30 years. That was a very talent-based business. Someone was thinking about leaving Wellington, and we started our hedge fund business. I was a hedge fund manager actually for 20 years.
What's the difference between running a long-only fund and a hedge fund? Hedge fund you can short, but you can also charge a carried interest, I assume.
Our hedge fund products, when we go to clients, they're very similar to every other hedge fund in terms of how we charge a fee. So we charge different fees depending on what products we have. Back to the opportunity set. As a global industry analyst, I was responsible for the opportunity set. That meant I had long positions, and then I could recommend people avoid.
So in the money management world today, is it harder to beat the benchmark against which you're measured, or is it harder to get clients? In other words, there's so much competition for money, but there's also so much competition to beat the benchmarks. What is actually more of a challenge?
I think the hard thing to do is to beat benchmarks over time. That is a very rare high skill.
So when you beat a benchmark and you advertise it to your clients, then more money comes in, I assume. But Is there a problem today in firms like yours in raising money, or there's plenty of money, just a question of who's the most competitive?
I think the bar for performance is very high today, meaning that if you want to grow your business, you need to outperform your benchmark. And we like to take a long-term view, so we think about it in 3 and 5 and 10-year periods. Can you consistently beat your benchmark? And Wellington as a firm will do well if we do that. If 75% of our strategies over 5 years are beating their benchmark and a third are in their top quartile, we're going to be a great business. But that's the bar. We have a very high bar for delivering investment outcomes for our clients. And I think that's why we've been successful over time, and that's why we've grown over time.
What kind of rate of return do you think an average investor, middle class, should get on his or her money when they put it in a Wellington account or something like Wellington? So what do you think people should be seeking in terms of rates of return?
Yeah, so I think if you look back over long periods of time, equities have returned 8 or 9%. Across the world, and bonds, in the 4 or 5%. So I think depending on your diversification between equities and bonds, you should probably expect between 5 and 10% returns.
So today you have privates as well.
Yeah.
So today the traditional 60-40 model, 60% in equities, 40% in bonds, many people have shifted that to having 20% as much as 20% in alternatives. And do you have a general view on whether alternatives are good or bad for your investors?
I think alternatives are a very valid source of diversification. Hedge funds can be very diversifying because they're very focused on absolute return and lower downside risk for that return. Privates, I think, are a way to invest in the economy. Right. And so when you think about the percent of the economy today that are in private companies, and there's many reasons for that. It's just much higher than it was 20 years ago.
So your focus is micro more than macro, but I just can't resist asking you, are you worried about the debt of the United States government, roughly $36, $37 trillion? Is that a factor into invest money, or just something you don't have to worry about that much in your job?
So it's clearly something I worry about. So when we think about what is the value of the world, that's going to be translated into the value of the different equity markets around the world. The level of productivity, the level of innovation, the level of debt, geopolitics, all play a role in that. So I do think that the level of debt is a dampening effect on the potential of the value of the U.S.
Many years ago, when Wellington was started, and then subsequent to that, when Fidelity was started as well, people used to invest in equities directly. The theory was a person who's really smart, let's say like you in the healthcare or medical area, you can pick good stocks. Yeah. But then the index fund came along, and people basically said you can't beat the market by picking good stocks or having good stock managers, just get an index. Yeah. How has it affected Wellington? And do you subscribe to the view that you really can't beat the market with smart money managers? Just get an index and you'll be okay?
Yeah, so we're a very proud, very proud active manager. So we strongly believe that, and if you look at our results over long periods of time, that we can, through great research across credits, rates, different sectors, that we are able to beat benchmarks. We wouldn't have a business if we didn't. But at the same time, the index funds and passive has been a tool, has been a way in a very low cost way for clients and individuals around the world to invest. And so it's a very valid asset class. But there's nothing better than compounding returns. And so if we can deliver excess returns over an index, that compounding effect over years is very valuable.
So if an index says the equity markets have gone up for 6% a year, if you can do 8% a year, 200 basis points over, that's good enough to keep people happy, I assume.
I think if you can deliver 100 basis points a year in an equity fund, that compounding of that 100 basis points is substantial over time.
Okay, so in recent years, one of the big phenomena in the money management world has been the advent of something called private credit. So debt is something that you've been involved with for a long time, but do you invest in so-called private credit?
The two big trends in the last 15 years have been passive and then alternatives, including the private private equity, venture, as well as private credit. We just started about 2 years ago, and we now have 3 teams that invest in credit. So that we're building our private credit capabilities.
And what about artificial intelligence? So is artificial intelligence changing the money management world, and how is it changing your own firm?
We're being very deliberate and intentional about investing in artificial intelligence. What I'm most excited about now, a few years in, is that we're beginning to see benefits. We're beginning to see this innovation happening with our employees, really changing how they work, some processes that they're changing how they work. And for us as an investment management company, and if I had to say what's the one thing about Wellington that's unique, is that we have about 500 people that invest, and we have a very collaborative ecosystem.
For Wellington, what do you see as the biggest opportunities for the firm and the biggest challenges for the firm?
If you think about the trends in the marketplace, what our clients are allocating to, they're allocating more to privates and more to passives. And so how does Wellington continue our shift over the next decade into alternative asset classes? And so we have a whole roadmap about how we're going to expand and accelerate our hedge fund business and how we're going to expand our privates business. So that's well underway, and now we just have to execute that. So that's the challenges are the backdrop of where our strengths are and where the markets are moving away from. I personally think we could also enter a period where active equities become more important because of the concentration in the market. If that concentration ever changes, then active equities could become more important. One of our biggest opportunities is the alliance that we just announced in April, and the fact of how do we deliver the best of Vanguard, Blackstone, and Wellington together in capabilities. If we can put together a series of products over the next 5 to 10 years, I think that will be a large opportunity for Wellington. I was just constantly learning. I was learning to be a great researcher. I was working with someone who was amazing, and eventually I started having success.
So Wellington is in Boston, based there, as is Fidelity and a lot of other well-known money management firms. What is it about Boston that has made it such an attractive place for money managers to be based?
I think it's exactly what you said, David. The fact that you have this concentration of very strong research-based, fundamental-based companies. So ourselves, Fidelity, MFS, Adage, Putnam, there was this group of companies. And so what that meant is that we constantly have companies coming into Boston, and that's that constant flow of corporations.
Who started Wellington?
The founder of Wellington, we're going to have our 100th anniversary in 2028, was Walter Morgan. He started the first balanced mutual fund in 1928. That fund now is the Wellington Fund. That is, we manage the fund, and that is a fund that is administered by Vanguard.
So let's talk about your own background for a moment. Where did you grow up?
I grew up in a town just south of Boston called Milton, Massachusetts. My parents are immigrants. They both came from Ireland in the 1950s. My father was a bricklayer, and my mother raised 6 children. So really, I was a first-generation college student.
So when you were applying to college, where did you want to go?
I ended up going to Wellesley College. I got almost an entire scholarship to go to Wellesley College. I remember having the conversation with my mother and father, and it was about $3,000 or $4,000, but that was a lot of money for a bricklayer raising a family of 6 children. But he knew, and they knew, that Wellesley would open doors for me.
What did you major in at Wellesley?
I majored in economics. It was an all-women's college. Well, economics was one of the most, I think it was one of the largest majors at the time. My mother, being from an immigrant family, they didn't know what economics was. So they kind of steered me towards computer science.
So you got a job at Wellington, and did your parents understand what it was, and did you tell them it was a great job?
My parents didn't understand what it was, but I was very interested in the business. I started as an administrative assistant. So I started at the very lowest part of Wellington, But a recruiter had told me, don't worry about the title. This is a great firm. The culture is amazing. You're going to have lots of opportunity.
Okay. And so was it filled with women with senior responsibilities at the time, or was it all male dominated then?
So if you go back to the industry in the early 1990s, most of the people, particularly the investors, were men. But I would say we had quite a number of female role models on the business side. But when I started, I was always in research, in the research department. I was one of very few women.
And did you ever think you could be the CEO?
No.
Okay, so what area did you specialize in? Was it ultimately health?
Well, I started in 1991. In 1993, I had the great opportunity to go and work with Ed Owens. So Ed Owens was my mentor and great friend for 20 years. He was the pharmaceutical and biotechnology analyst. He managed the Vanguard Healthcare Fund. And so I got to go and work with him starting in 1993. And it was just a match made in heaven in terms of allowing me to really learn how to be a great analyst in biotech and pharmaceuticals. So most of my career was focused on analyzing and recommending and investing in biotech and pharmaceutical companies.
When did you realize that you had a chance to advance and you weren't just going to be there for 1 or 2 or 3 years, but you could actually stay there your whole career? At what point did you realize you were pretty good at this?
I had a very slow start and then an acceleration. I started as an administrative assistant. A few years in, Wellington was a very flat organization, and they created what is now we consider a research associate position for me. So I was just constantly learning. I was learning to be a great researcher. I was working with someone who was amazing. Eventually, I started having success in recommending stocks. So I had this luxury of 4 or 5 years of really learning to be a great researcher. But because I came from an administrative position, I think it took time for people to sort of gain confidence in me and me to gain credibility. But once I really sort of came out of Ed's umbrella and really began to be my own person who was recommending stocks, then sort of the advancement happened faster.
And so at what point after you're there 5 or 10 or 15 years, did you say, hey, I could be the CEO?
Probably around 2008, I was very interested in leadership. So there's a big gap between being interested in being CEO and being interested in leadership. I started getting asked to be on committees. I started being asked. I moved to London. I moved my family to London in 2007 as we were globalizing our investment platform. When I think about that period of time, that was my real journey on being a leader.
All right, so you come back eventually from London, and then you realize you're maybe on a track to get to the top. And how many years before you became CEO?
When Ed retired, I became team leader of the healthcare team. That's like running a little business within Wellington. And the healthcare team is a very important team at Wellington. I became a managing partner. Wellington is a private partnership. We're governed by 3 managing partners. And I was elected a managing partner by our partnership in 2014.
When you meet clients around the world, do they ask you where the economy is going or how Wellington's doing? What is the thing that they want to know the most about?
I think what they want to know the most about, because they know my areas of expertise as well, is what are your investors saying about the world? So they're very interested in that, and they're also very interested in trends, like what are other clients thinking about? So we have lots of discussions about what areas of the market are most interesting, where are the areas of opportunity, what's our product capabilities, and what are other clients interested in doing as well.
You're not making the day-to-day investment decisions today, but how do you keep up with what your investment professionals are doing? You just look at what their performance is. How do you deal with the investment professionals, or somebody else that does that?
We have a management team that manage our investors, but as a managing partner, I'm responsible for the compensation of all our partners and managing directors at year end. So I study, our individual investors' performance quite intensely, particularly at our year end compensation process. So I feel it's very important to stay very connected to the investment process and very connected to the talent. We're a talent organization and those who are making the decisions for our clients. If you want to be an investor, make sure you're very curious, make sure you're constantly learning, make sure you're learning the skills of the future.
Now, some people in the money management world would say they're doing good things
Yeah.
for the world. Other people who are not in the money management world would say all you're doing when you're in money management is getting rich people, making them wealthier. So how do you say to people who are joining your firm, in the money management world, you're doing something that's socially productive and
Yeah.
useful? How do you explain that?
So I think what's our mission and purpose as a company and as an industry, I think it's underappreciated that back to that compounding. What we're really doing for our clients is in the end, we're helping their beneficiaries. We're allocating capital to the world, right? And so if we do a really good job, our number one mission is outcomes for clients. Sort of a secondary mission is allocating capital so the world can grow and be innovative.
So if somebody came to you and said, I have $1 million and I don't really know what to do with it, what do you tell people to do?
I think most importantly, it's how do you get access to the economy? So how do you get access? So how do you get access to income, depending on if you want some income and diversification? In the end, like when you're investing in the growth of the world and the economy of the world. So how do you find those avenues so that you can benefit from that innovation?
What is the best investment advice you ever received from somebody about how to invest? Your mentors, other people, what's the best you ever
so
got?
I think it's advice, and it's also just osmosis of working with Ed Owens for so long, and he was an incredibly, I would say, voracious learner. So just like constantly learning, that would be one. He was also just very humble. So one of the things we say at Wellington, like we're not a star culture. Like the two combinations of being great investors are being super curious, being humble, and being resilient. He never got too attached to a stock, so he was constantly taking in new information and pivoting if he had to.
What do you think is the most common mistake that investors make?
Well, you probably know this over time, like the noise in the market, the constant data has changed the investing in 2025 versus what it was in 2010, and even in, like, if you go back to my first 15 or 20 years, the information flow can be a distraction. So how do you really focus on what's most important? What's going to create value? And you have to, what gets people in the way now is that short-termism.
So let's suppose somebody's watching and says, I want to be like you. I want to go to college, go to a money management firm, rise up to be the CEO. What are the skill sets that you recommend somebody develop if he or she wants to rise up in the money management world?
This is what I say to my daughters all the time, like, and young people all the time. Be super curious, always learn. And we have a new class of new hires, and I said to them, just because you graduated from college does not mean your education's over. So constantly learn. Like, I've been constantly learning sort of my whole career. Back to when I was in London, at that London experience, I sort of became a voracious reader of leadership. So that was sort of in my own time. In the last decade, since I've become a managing partner, and you asked me, did I ever think about myself being a CEO? I never did. I never thought I had the skill set. What I say to young people, if you want to be an investor, make sure you're very curious, make sure you're constantly learning, make sure you're learning the skills of the future, which I think are coding and artificial intelligence and how to use data. Make sure that you are building skill sets that are important, like knowing who you are, knowing what your strengths are. Take feedback. That's the one thing I tell my children. Seek feedback at an early age and learn how to give feedback and learn how to take feedback.